All right, good morning, trade pros. Welcome to our morning market update for April the 14th. It's Tuesday. All day, it's Tuesday, believe it or not. Morning, guys. Morning, everyone on YouTube and in our live trading room. Let's talk about today, because today was a very vital day, highly anticipated. Do you know why it's highly anticipated? Because it's the kickoff of the earnings season with two big banks reporting, JP Morgan, Wells Fargo. We have the rest of them tomorrow, including Goldman Sachs, which is a really big bank, and Morgan Stanley. And so we're going to take a look at those earnings, but first let's talk about the Asian session overnight. China reported a trade balance for the month of March, which everyone thought was going to be horrific, but it came out at 19.9 billion versus 18.55, the previous of minus 7.9. So back to a positive export balance for China, which is good. The reason it's good is people look at China as the model of COVID-19, how we pass through it, how the cases decrease, it peaks and decreases. So the curve is kind of mapped out based on China, and we're comparing all other countries in relation to that. But China's now getting a little bit of a second surge of COVID-19 cases. Nonetheless, U.S. has sort of hit the peak, or will be hitting the peak this week, along with Europe. So there is some positive flow there. All right, in Europe, Eurex was having some data and connectivity issues this morning, and the European session, DAX and other markets were affected. So keep that in mind. And now let's talk about the bank earnings. Let's start out with JP Morgan. Right? JP Morgan had an expectation of $2.51 per share of earnings. Nobody thought that was actually going to happen. So, who expected that? That was an analyst expectation that was drawn up before this COVID-19. Nobody knows the economic impact this will have, and we still don't know yet. I think now we're in the thick of it. All right, so what came out 78 cents per share versus 251. The revenue was $28.3 billion versus 29.71 expected, with a profit that's down 70% year over year, but still positive $2.8 billion. All right, isn't it nice for your revenue to be, or profit to be down 70% a year from a year earlier and still make $2.8 billion? Right? Start a bank. You could steal people's money legally. Just kidding. This is not my real sentiment. All right, so it's the biggest annual drop since the Lehman quarter, and there was $8.2 billion in loan losses. Typically when bank earnings come out, I should probably explain this because it's important. Typically when bank earnings come out, people care about credit cards, loan applications, the growth of trading and sales revenue, all right, the growth of investment banking, the growth of a whole bunch of other stuff, fees charged on cards, that sort of deal. This quarter, nobody cares about that crap. What's more important and most important right now is losses. How much money did you write down, and what's your provision for future losses? That's the important part that everyone's looking at. You need to know that. So essentially what JP Morgan did was $8.2 billion in loan losses. All right. The street was looking for $2.9 billion. So massive loss in comparison to the expectation. But who cares what the street's looking for? How do they know? All right. How do they know what it was going to be? They don't. And so it turns out that it's a lot worse than the street expected. All right. They also built $6.8 billion of reserves for write-downs of future debt. So really, and Jamie Dimon, I don't know why I put a French spin to his name. I prefer it that way. Warns of a severe recession. Okay, so how come the market is up 1.2%? It was up almost 3% in the morning. Here's why. I think that even though the losses were terrible, okay, now keep in mind, this is just for March. Most people aren't feeling the pinch at the end of March. They're sitting at home. They may have been laid off in March, but really the cash flow problems begin in April. So the first quarter avoided what could potentially be the worst quarter. I think the second quarter is the one that's going to have the impact of COVID-19 from an economic standpoint fully baked in. So the first quarter, we skimmed by, just like other things. It just kind of started towards the end of the quarter. All right. So how come the market's up? Because JP Morgan put aside money for the loss provision. So in the future, they could write down $6.8 billion worth of losses and still not hit the Q2 report because they've put that aside as a future amount. And so that's kind of a positive skew, if you will. If this is the worst it's going to get and the bank's preparing for a little bit more, but it doesn't use up that amount of cash, all right, then that's actually a positive thing. So behind this report, it wasn't a terrible quarter for JP Morgan. It wasn't good by any stretch of the imagination, but you don't have to be genius to know that the last quarter hasn't been good for businesses. All right, so this isn't that bad of a report, which makes it kind of good in the stock market's eyes. I didn't make up the rules. I'm just following them and making money off them. JP Morgan's weight is 2.97% in the Dow Jones overall average. All right, let's look at Wells Fargo because we had a second bank report today. Wells Fargo reported just 1 penny. All right, 1 cent of earnings per share versus 72 cents expected. All right, revenue was 17.9 billion versus 19.48 billion. So that had a massive drop in revenue. Loan charge-offs were 0.38%. All right, versus 0.3 prior, so it's not really that big of an increase. And they had 6.8 billion in loss reserves. So it's a pretty big hit for the first quarter, lose 6.8 billion dollars on loans associated to COVID-19. It's not like they lent money for COVID-19, but businesses cite that as a reason for the losses, and that's an interesting figure that they report. All right, and provision for credit losses at $4 billion versus $845 million year over year. So almost 5 times as much and the most in a decade. But, that's not a surprise. They're preparing for this kind of thing. All right, pre-market's up 1.8%. It was up as high as 2.5%. Wells Fargo, not a spectacular report. If they reported this and the market was at all-time highs, it'd be tragic. But if they're reporting this after almost a 40% drop in the market, due to the coronavirus, it's not that bad of a report. It's not that we expected losses. We expected provisions to be baked in for future losses. It's par for the course. What would have been terrible? Like huge losses, big default rates. Even though the CEO said there's a severe recession ahead, these current earnings don't speak of it at this very moment. Remember, if this, the economic damage hasn't been done yet, if we start to reopen businesses and we slowly acclimatize back to some productivity, all right, and COVID cases are peaking off, they're dropping, at some point there's a balance where it's like, we have to get the economy started again. That can't happen too soon because there's lives at stake. So, people share their opinions on YouTube comments, and it's like a de facto, like, this is what you should do. If it was that easy, no offense, it would already be done. Right? The hard part about the economy and everything overall is that there isn't really a right response. You're always going to give something, but you got to get something, and there's always a trade-off. All right? So, restarting the economy too soon could put humans at danger, their lives. Yes, it's only a couple lives of the global population, but if we start to think that way, are we putting a cost to the life? All right? And what does life cost? And if there's a cost to the life, what is ours worth? What is yours worth? And what does it mean if somebody has a higher worth? Who gets to do that valuation? You know what I'm saying? It's a very dangerous ground that we're stomping on. So the question now is, how do we reopen this economy? Because Q2 is going to be the big quarter here. If there's going to be huge defaults and we slip into a recession, it'll be the second quarter. Because March was pretty much all about the lockdowns. People lost their job. They still had some savings. They were able to pay rent. April, the picture is completely different. Extend this lockdown another 30, 60 days. We'll be sitting here in 3.5 months' time talking about Wells Fargo again, down pretty big. And so will markets. So I think we skirt by on the first quarter of bank earnings. And even though they're bad, they're not terrible, which in effect is good. S&P to overnight high is 2810. We just popped. All right, erasing yesterday's losses more or less. Another news report on earnings is Johnson & Johnson, massive company, the J&J, two Johnsons together. J&J. All right, that's their symbol, J&J. For Q1 earnings, they reported $2.30 per share versus $2 expected on $20.7 billion of revenue versus 19.48. They boost their dividend by 6.3%, but they lower their guidance to reflect COVID-19. All right, very smart move by Johnson & Johnson because they make the kind of products that are going to actually make you money during COVID-19. But you use that as an excuse, say, oh my God, COVID-19 is wreaking havoc on the economy. We're lowering our guidance. Next quarter, they report a huge beat and it pops. All right, typical, very typical. It's been the game in town the last 7, 8, 9 years. You know, if you don't know that formula, then where have you been? Darn it! Right? You set a very low hurdle and you jump over it and say, "Wow, what a massive beat on earnings!" But then you compare it versus the previous year and you're actually down. And so, yeah, Johnson Johnson has the biggest weight on the Dow of all the companies that we've reported so far. 4.1%. It was up over 3.5 in the morning. So it's driving the upside in the Dow Jones. It's not the banks, all right? The weight in the banks is less than Johnson and Johnson. Johnson Johnson's up pretty big. So there you have it. The earnings season's kicked off. The banks did bad, but not terrible. The markets are reacting good. In today's market, I'll give you guys a quick little quote. That's all I plan to talk about. S&P is up 44 points. Dow Jones up 382 points. Europe, everything's green across the board. DAX is up 114. Let's look at Asia. Markets up green in Asia as well. Literally all across the board. I can look at currencies as well, but let's not do it. We're already into a pretty long report. So there's a rebound here. All right, there's a rebound in markets. We're off the overnight highs, and you could like it or you could not like it, but don't let that affect how you trade. All right, if you're out here thinking, I lost my job, or I have friends that lost their job, people are losing their lives, the economy's terrible, the market should be down 30%, damn it, I'm gonna short. All right, that's not the right way to think. Look at what the market's doing and take advantage of it. By the time you justify why what's happening is happening, you're missing the trade. What's important to you? Knowing why something's happening or making money. All right, and that's how I'll leave this morning market update. I'll tell you guys, be careful. All right, earnings are kicking off with the banks. Next week and the week after, we have a huge amount of banks reporting earnings. Keep your eyes out. We're not out of the woods yet, but these reports aren't that bad. We expected losses as a result. The question is what happens in Q2? We're going to have to wait 3.5 months to see the results. And there's a scenario where 3.5 months, fast forward to the future 3.5 months from now, which makes it, what does it make it? April, like September. All right. So actually it'd be July. So January, February, March, April, May, June is the second quarter. It finishes end of July, mid to end of July, we start to see earnings season come out. So, it's middle of July 2020. Let's fast forward. And businesses are reopening. Okay. And things are starting to go again. People are starting to get jobs. The economy's restarting. So it's not chugging along, but it's restarting at that point. And then earnings come out saying the second quarter was bad. Well, that's kind of late, right? Remember, we're always reacting in earnings to 3 months past data. It's old information, if you will. And so we have the potential, even if it gets really bad, for things to still be good. I don't want to see this market drop. I don't want to be a doomsday caller. And I do think we're going to get a little bit of a downside test because now we pushed up a little bit too much. But as it sells off, we're going to see if there's going to be some buying. At the moment, it's not going to. Look for some strength this morning. I think we opened strong. We continue to rally upwards strong. Might get those 28.70s today. All right, love you guys. Have a good rest of your day. Be careful. Manage your risk. TRADEPRO. I'm going to open up to Steven for oil. Bit of a longer update, but I was away yesterday. So I had to catch up. I think I made up for it. Bye, guys. Take care.